And ooh, sounds so official. And Harper, I'm going to go ahead and take it away. Everybody else is muted. I'm going to mute myself as well. Thank you so much for taking the time out and all the work behind the scenes. We really appreciate our MI partners. We've known each other for a few years. I guess you just say 20 plus at this point. You know, when it's over 20, it doesn't really matter. But yeah, this is a wild market, and any tools we can give the team to be able to move forward, we need to give them. So take it away, Harper.
All right. Well, good morning, everybody. Thank you again for your patience as we get the technology worked out, and for the invitation and warm introduction, TJ. Yes, we have known each other. We're trying to figure out how long it's been, but needless to say, we're tenured in the industry. But to your point, things have changed, and some of the products that are coming into vogue or becoming very prevalent in our market are tools that we haven't used for a long time. And actually, there are some ARM products that are new. With SOFR, we haven't seen SOFR before. I think it's a great opportunity to just be acquainted with ARMs, or for those people who are newer to the industry. And when I say newer, I mean, you could be in the industry for 20 years and never have been in our market. So this is a great opportunity to relearn some of the products that are coming into vogue so that you're prepared to talk to your borrowers about them. As I mentioned before, TJ, we have a recording done by Kevin Hurden, our Director of Product Development. It's about 30 minutes. We'll go through that presentation. And anybody who wants the recording, it's certainly available. I can send you the link, as well as the slides. So I'm going to go ahead and share my screen. Once we go through this presentation, I'll pause the recording, and we can have questions and answers afterward. I'm always available for any MI questions. Of course, we appreciate your MI business. It's how I make a living, is by earning your mortgage insurance. So don't hesitate to reach out to me anytime you have a scenario or you have questions about MI. We have great resources to support our MI partners. So please reach out to me. So with that, I'm going to go ahead and share my screen. And hopefully everybody sees that. Yes?
Yes.
All right, great. Thank you. And I'm going to go ahead and play this. And like I said, I'm going to be in the background. I will probably mute myself just so that we don't have any background noise, and then we'll come back for Q&A. So here we go.
MGIC's Director of Product Development, Kevin Hurden. Kevin, go ahead.
Well, thank you, Alexis. Good afternoon to all, and good morning to our friends in Hawaii. I heard there were some Hawaii attendees. That's great. We're excited to dive into this very hot topic of adjustable rate mortgages. We have terrific attendance today, and are hopeful you'll gain a strong understanding of today's ARM products. We have a lot of content to cover, and I'll be moving quickly to keep us on time. We will be staying on past our scheduled 30 minutes to help with your questions. Before I get started, our MGIC legal team asked me to include this slide and let you know that any opinions I share today are my own and not necessarily those of MGIC. With that, let's review our agenda. We're going to talk about why now, why ARMs have become such a hot topic. We're going to cover some basics. We'll talk a little bit about qualifying with ARMs and how that might differ from fixed rate products. We'll do a product comparison, and we'll talk about GSE guidelines, so Fannie Freddie guidelines and pricing for ARMs. And we'll cover some borrower considerations, some additional thoughts for you around ARMs, and then again, stay on for a Q&A section. So why now? This is a graph from the Freddie Mac Primary Mortgage Market Survey. You may be familiar with this. It's a well-known mortgage market survey. And what we see here in the blue line is the increase in fixed rates that you are probably well aware of. So fixed rates kind of jumping up here in the last couple months. So of course, that's going to drive in and of itself interest in adjustable rate mortgages because of the lower rates. Now, this particular survey shows a difference of about 1.5% when we account for points that are involved in these. So it's not only, you know, the fact that fixed rates have gone up, but it's also the spread between fixed rates and ARMs. If you see, you know, recently where we have this wide spread, if you look back just, you know, to like January 21 or so here, you can see there's almost no spread between fixed rates and ARMs. And so there's not going to be much appetite for ARMs in that type of environment. So we've seen, again, not only rates increase, but the spread and also the speed at which they've increased, kind of the slope of this line has driven, some of the interest in activity in ARMs. I think it's helpful to have a little bit of a historical look at ARM market share over the years. This chart here is from the Urban Institute, and they publish this monthly. And you see the blue line or the blue shaded area, quite thin here in the last year or two in terms of ARM usage. And that's not surprising given the level of fixed rates. But then we look back here, kind of pre-crisis, the 2003, 4, 5, 6 era, and ARMs were a large percentage of volume that was being done. So one of the things I just wanted to point out is the ARM discussion we're having today is focused really on, kind of traditional secondary market Fannie Freddie qualifying standards and product features. What I think was different during this time period here is you had a number of different features within an ARM product. So not necessarily the product itself, but other features. What do I mean by that? Oftentimes, there were products during these years where the interest rate was adjusting very soon after closing, maybe the first year or even less than that. There might have been other features like stated income, stated asset, or negative amortization, or interest only. Those types of features combined, in my opinion, were really more of the issue in terms of how those loans performed through the crisis than the fact that it was an ARM product in and of itself. So let's start with ARM basics here. What are the key structural elements of ARMs? We're going to talk about types of ARMs. We'll cover the index, the margin, what fully indexed rate means, and then we'll talk a little bit about interest rate caps. So ARM basics and the ARM types, I also refer to this as the product structure, the actual ARM product itself. So ARM products will have an initial fixed period, and then they'll have a subsequent adjustment period, and those both are going to be of different frequencies. So the first part, the initial fixed period, can vary. That can be anywhere typically from 1 to 15 years, and then the adjustment period thereafter might be 6 months, it might be a year, might be up to 10 years. So what are some common ARM products maybe you're seeing today and starting to think about for your borrowers? Well, 5/6, 7/6, 10/6 SOFR ARMs. I'll talk about SOFR in a minute, what that means. And so, for example, this would be a product that's fixed for the first 5 or 7 or 10 years, and then it is adjusting every 6 months thereafter through the life of the loan. Another common ARM product set would be the 5/1, 7/1, 10/1 CMT ARMs. I'll talk about CMT as well. So there, it's simply fixed for the first 5, 7, 10 years, and then just annually or every 1 year thereafter. So product structure, initial fixed period, and then subsequent adjustment period through the life of the loan. Let's talk about the index next. So the index is really kind of a benchmark that determines how the interest rate adjusts. And the index will reflect borrowing costs at the time of that rate adjustment. At the time that's occurring, where is that index at? What are some typical ARM indices? SOFR I mentioned, which is the secured overnight financing rate. So that's a relatively new index that came into play post some issues with LIBOR that you see here also. And then the CMT, or constant maturity treasury, that's typically a 1-year CMT. That is also, a pretty popular index that you'll see in ARM products today. LIBOR largely being retired and phasing out. And you might be familiar with other ARM indices, maybe, for example, prime rate, that might be useful for HELOCs. For Fannie Freddie ARMs or GSE products, SOFR has replaced LIBOR and CMT. Fannie and Freddie are only buying SOFR ARMs today, although the CMT index is still popular with depositories of banks and credit unions, as well as correspondent lenders who may be offering CMT-based ARMs. Looking at the margin next. So the margin, along with the index, is a component of the rate adjustment calculation. Okay, so those two, index we just covered, and then margin. So the margin is simply added to the index to compute the new adjusted interest rate. So when it's time to adjust, index plus margin. That's the actual margin for the product, it's gonna vary based on that product, those product details. You have to pay attention to that. Typically, not always, but typically you're going to see maybe something in the 2 to 3% range for a margin. But that margin differs from the index, and that margin is fixed. It's set for the life of the loan. So if it's a 3% margin on the ARM product you're using, that margin stays consistent through the life of the loan. Let's look at interest rate caps next. So these caps place limits on the interest rate change. The amount of change that can occur to the interest rate is limited by these caps. And there are 3 types of caps, okay? There's the initial cap. So this means at the very first time the interest rate is going to adjust, what is the amount that that adjustment can be at the first time? So then there are going to be subsequent caps, and those would limit the amount of rate change after that first adjustment. And it's going to adjust, of course, based on the most recent interest rate that occurred, right? But it's going to be each subsequent adjustment is going to have a cap on it. And that cap can differ from the initial cap. And then the third item is a lifetime cap. So that's the lifetime maximum interest rate adjustment or interest rate adjustment that occur. That's often going to be maybe 5 or 6%. What are some common interest rate caps? So for Fannie and Freddie, they're 3.6 and 5.6 SOFR ARMs. Those have 2.15 caps. So 2 is the initial cap amount, 1% is the subsequent cap, and then 5 over the life of the loan. Another cap structure might be 5.15. You see that on 7.6 and 10.6 ARMs. And then looking at some of these CMT-based ARMs, the CMT index, you might see 2.26, or for these, for the last line here, the 5.1, 7.1, 10.1 ARMs might be 5.25. So again, initial cap 5%. Each subsequent cap, the amount the interest rate can change would be 2% and 5 over the life of the loan. Sometimes folks wonder about a floor, like can the interest rate go below a certain level? That's going to depend on your specific product, but oftentimes the floor is the margin. So the margin that's identified for the product, that's as low as the interest rate can go, unless it's otherwise identified within the loan product. Let's look at fully indexed rate. What does that mean? So the definition of fully indexed rate is the index plus the margin. So the fully indexed rate, or sometimes called the fully indexed accrual rate, that's simply the index plus the margin. That fully indexed rate at origination may or may not be equivalent to the note rate. So today, if you're doing an ARM product, it has an index, it has a margin, you could add those two together, and those might differ from the note rate. That's not necessarily anything wrong with that, but just something you should be aware of. The other thing that's important relative to fully indexed rate is understanding that borrower qualifying may be based on the fully indexed rate. So their DTI for qualifying may be based on the fully indexed rate and not the note rate. We'll touch on that a little bit more here shortly. I wanted to show you an example, like what would happen at, at a time of ARM adjustment. So as I mentioned, at time of ARM adjustment, you're taking those two components, index plus margin, and that's going to determine your new adjusted interest rate. So a couple examples today. 30-day SOFR sitting right now at about 0.533%. Let's say you had a 3% margin for your particular loan product that's using the SOFR. That's simply 3.533. Add them together, right? And then there's a rounding feature that, according to the note, typically it's going to round to the nearest eighth. So the reset rate, the adjusted rate, would be at 3.5%. One more example here. So what if you're using the 1-year CMT as your index? Well, that today is sitting around 1.567. We're using the same margin, 3%, adding the two together. And again, simply rounding, the new interest rate would adjust to 5.625. So pretty big difference between these two, right? So you're gonna kind of have to pay attention to that as you're working with borrowers and considering, an ARM product as an option for them. One of the things I think there's a little bit of misperception about ARMs is people, I think, when they're considering an ARM, they're kind of thinking about, well, I know it adjusts, right? And it's probably going to go up, and maybe it would go up, but we don't know. It depends on kind of the movement of that index over time. So here's just for a bit of a view. As I mentioned, SOFR is a relatively new index, and we see over the last couple year period here, other than kind of a spike that occurred during COVID, very low levels, right? And now it's starting to creep up. So, another view of this. So this is the SOFR index. What if we look at the CMT? I also had shared, an example of that. Well, Much longer history here, much greater volatility over the decades. Imagine there's some folks on the call who kind of remember this, late 70s, early 80s period where interest rates were super high, relative to historical. And think about it here, if you had maybe in a 1-year CMT index on your ARM loan and rates were around 15%, you had 3% margin, you could be adjusting to levels up to 18% on your interest rate for your mortgage. Now, that's assuming you weren't limited by the caps we just talked about. But again, important to understand there can be a wide variability in how these indices perform over time. Moving on to qualifying. So here are some Fannie Mae standards. Now, the qualifying rate, again, for the DTI calculation will depend on the ARM product and investor. Fannie Mae is just an example here. You may have internal guidelines for your products for portfolio lenders, or you may be working with a correspondent investor that has different standards. But this provides us a little bit of a view as to what qualifying for an ARM entails. So as you can see here, this is taken right from the Fannie Selling Guide. So what they're saying is ARMs with initial fixed period of 3 years or less, you qualify at the maximum interest rate that could apply during the first 5 years, okay? Whereas ARMs with fixed rate period of 5 years, you qualify at the greater of max rate that could apply during those 5 years, or the fully indexed rate. And then ARMs greater than 5 years, you're going to qualify greater than the note rate or the fully indexed rate. Here's a similar view from Freddie Mac, at least in terms of the guidelines themselves. So 3 6-month ARMs, so that would be fixed for the first 3 years, adjusting every 6 months thereafter. You're going to use the note rate plus the life cap. In this example, life cap is 5%. And then just, to move through this, looking at the 7 6 and 10 6 ARMs, they actually qualify at the note rate unless the loan is a higher price covered transaction or higher price mortgage loan. So you can see a little bit of variability even in the GSE standards for qualifying. What about the guidelines themselves and pricing? So important to know for Fannie Freddie products anyway, the max LTV is actually 95% for ARMs. So with the fixed rate, it's 97 with some limitations to both. Even with Home Ready and Home Possible, they're affordable programs. The maximum LTV for ARMs is 95%. Another thing I'm pointing out for us here is our loan level price adjustments, or LLPAs, and credit fees. That's Freddie's term, credit fees. Just something to be aware of if you're selling an ARM product to Fannie or Freddie, or you're trying to offer that product to one of your borrowers because your company offers these products. If you're above 90 LTV, there'll be a little bit of a pricing ding, 0.25% for Fannie Freddie ARMs above 90%. So again, I'm trying to be careful here to point out that this is just Fannie and Freddie, and they're not necessarily the market for ARMs or a good reference point. Other investors may have different guidelines and pricing, so important that you're paying attention to that. What about MJC mortgage insurance? What do we need to think about when we're thinking about MI for these loans? I want to point out that MI premiums are the same for fixed rate loans, so your 30-year fixed rate, right? And for ARMs with an initial fixed period of 5 years or more. So your premium rates will be the same. If you're looking at an ARM with an initial fixed period of less than 5 years, then you're going to see different MI premiums on those. And then one other thing I'll point out for borrower qualifying, we'll follow Fannie and Freddie standards on the loans that are run through their AUS and kind of are designed to meet those EUS requirements and guidelines. But if you're doing a portfolio loan that's not really intended to be a GSE type loan, we will qualify at the note rate for fixed periods of 7 years or more. So 7 or 10-year products, 10-year ARM products will qualify at the note rate. And you can see our underwriting guide for full details about that. Okay, I'm going to take a little breather here. We just ran through a bunch of information. Now let's pivot a little bit and think about borrower considerations, right? They're the ones who have to decide what loan product fits best. And really, to try to simplify this in my mind, it's really about trade-offs, or more specifically about one trade-off, and that is, in theory, they would choose an ARM product because it's going to provide a lower initial payment for them. But the trade-off for that is, well, they don't know what the future payment's going to be. It's going to adjust, right? And it's going to adjust based on that index and margin. And so that brings uncertainty and risk. So how do we help them think about that risk of that trade-off? So I put together the simple grid for a $350,000 loan amount. Okay, what we're doing is simply comparing a 30-year fixed rate versus a 5/1 ARM. So I'm assuming here an interest rate of 5.5% on the 30-year or 4% on the 5/1 ARM. I'm going back to the earlier slide when we looked at the Freddie Mac primary mortgage market survey. I'm just using that as a basis for this. Understand that the interest rates you may be seeing in the marketplace could differ substantially from this. But looking at that Freddie survey, we have a P&I payment on the 30-year of $1,987 versus $1,671. So pretty difference, right? $316 a month. That's pretty substantial, pretty motivating for borrowers. And I said, well, what if they, you look over that whole 5-year period of that ARM, that's 60 months. Well, that 316 over 16 months is going to be almost $19,000 that they're going to be saving over that initial 5-year period. And then I have a line here for additional equity. So what is that all about? So in addition to them having a lower monthly payment with a 5/1 ARM, because of the lower interest rate, more of that payment each month is going to go towards equity than it would with a 30-year. I'm going to repeat that. Even with the lower payment, more of that payment each month goes to reducing principal and building equity than it would with a 30-year. So how much more? Well, over a 60-month period, that would amount to a difference in principal of about $7,000. So you'd be at about $7,000 less. So you add those two together, now you're sitting on $26,000. That's a big number, right? It's going to be pretty motivating for borrowers. But then we need to look at the trade-off here. And so I'm assuming for this particular ARM product, it has 525 caps. We talked about those caps a little bit. And so 5% initial cap. Let's say 5 years is up, interest rate adjusts based on the index and margin. And in this particular case, it goes all the way up to the maximum, 9%. Well, that's going to make a big difference in my P&I payment, right? My P&I payment is going to jump all the way up to $2,657. So almost $1,000 a month more than the prior ARM payment and $670 a month more than where the 30-year fixed payment is. Of course, the 30-year fix is not changing, right? That stays $1,987 through the life of the loan, but now my 5/1 ARM payment has jumped up and I'm substantially higher. One example of a trade-off, something for you to think about, and as you look at individual transactions, think about how these numbers might compute for your example. Let's take a look at this. So what I tried to do for us here is summarize some advantages and disadvantages for ARMs versus fixed rate. And we kind of covered this in a general sense, but let's just step through it. So ARMs going to provide a lower initial interest rate. That's the motivation, right? Plus greater equity. We just covered the math there in the short to intermediate term. We don't know what's going to happen long term. So that helps borrowers save, invest money elsewhere, and essentially is going to be, again, in the intermediate term, a less expensive path to buy a home for borrowers, at least initially. Fixed rate, interest rate and payment are constant. We know that, right? So easy to budget long term, easy to understand and explain to borrowers. The disadvantage piece, we just looked at how much that rate and payment can rise, and it can be pretty significant. So there's a risk of payment shock. No one wants their mortgage payment to go up $1,000, I don't think. And ARMs can be a little bit more difficult to understand and explain. So on the fixed rate side, well, you might have a higher initial payment, or you would in theory. That would be a disadvantage, a higher initial payment. You're going to be building less equity again in the short to intermediate term. Certainly rising rates have impacted affordability. We've seen that, a lot been written in the industry about affordability and contribution that the increase in fixed rates has had to creating more challenges around home affordability. And then the other thing I just wanted to point out here is fixed rates. Pretty sure everyone on this call has a loan product available to them called a 30-year fixed rate. And so there's not a lot of variability between those. Interest rates might, are going to vary a bit between each lender. not a whole bunch, right? And everyone has a 30-year fixed rate product. On the other hand, to the extent you are familiar with the ARM products your company offers, you're knowledgeable about these, you can have intelligent consultative conversations with borrowers and referral partners. I think that's an opportunity to differentiate yourself a bit in the marketplace. So is an ARM right for your customer? Some thoughts around that. How long do they plan to own the home? Is it a few years? Do they intend to move? They have a lot of job change, that type of thing. How important is payment certainty? Are they comfortable with the risk of the payment increasing? Again, we don't know that the payment is going to increase. It could happen. That's the risk they're taking. Are they comfortable with that maximum rate? Is it likely that their income will increase or decrease? Do they anticipate major expenses, maybe some tuition upcoming or a new car, that type of thing? What are their interest rate expectations? I have careful here because my belief is nobody knows where interest rates are going to go. The Federal Reserve has told us they're expecting to raise rates in the short term. That's very likely to happen. But over the longer term period, a couple years, 5 years, we don't know. We don't know what's going to happen to interest rates. So you got to be a little careful with that type of thing. And again, I think where you as a lender can add value is to help show them the options and what's available to them, and show them these types of numbers, not only payment, but where payment could go in the longer term. Some other considerations here. Again, I gave some examples. You have to look carefully at what ARM products your company offers. And with the current interest rate levels, there might not be much of a difference between your 5 or 7 or 10-year ARM product and fixed rates. That's something that's controlled by the investors you use and the products you offer, and potentially whether you're a depository lender where you have portfolio products. Something to be aware of with ARMs, there are certain ARM disclosures that are provided to the borrower in what's called a consumer handbook on adjustable rate mortgages, or CHARM booklet. That are useful. And I'll also point out something regarding the annual percentage rate, or APR. APR can be a little bit difficult also for borrowers to understand. And it gets a little bit more complex with ARMs because that APR is calculated based on a blend of the initial rate, so their note rate they'd be receiving at closing, and the fully indexed rate. So I'm not super knowledgeable about that, but I'm sure your systems will kind of provide those calculations to you, and just something to be aware of. I guess in theory it's possible you could have a loan with a lower note rate than a fixed rate, but that APR number, because of this blend, could be higher than a fixed rate. So something also to make yourself kind of familiar with. All right, so that's our content largely for today. We talked a little bit about types of ARMs. So that was, remember, each ARM has an initial fixed rate period and then subsequent adjustment. Those are defined within the loan product. We covered the index, that's the benchmark, along with a margin that helps us determine how rates are going to change over time. What it is, that specific calculation, what's the math around that. We talked about the fully indexed rate, so that's the current index plus the margin. We talked about how interest rate caps can limit the amount of rate change that can occur at time of adjustment. Those are important to pay attention to. Did a little bit of a product comparison. We showed that, boy, you can sure save a lot, in the short term, depending, on the actual rates you have available. You can still save a lot. And then we talked a little bit about borrower considerations, like how long they plan to be in the home. Are they comfortable with the risk? What do they expect their income to do over time? Now, as we wind up here and we start to look at the questions that have come in, a few things I wanted to mention to you because I think they're really useful, kind of going back to that concept of differentiation. And we know it's a very challenging mortgage market, compared to the last few years, and you're looking for tools to help, compete and succeed. So a couple ideas for you here. Go to mjc.com, look at tools. We have a relatively new campaign about Rethink MI, and I think there's a really terrific strategies about how to think about MI maybe a little differently than you have in the past. And then a couple of my favorites here. One concept, 15 is greater than 20. MI premium is very affordable at 85 LTV. Sometimes it makes a lot of sense for a borrower to think about a 15% down payment with or 15% down payment with a little bit of MI that's going to be affordable and help to maybe hold some reserves for future expenses. And then we have a great product suite, our portfolio playbook, largely applicable to banks and credit unions, but also can be relevant to mortgage bankers who might have relationships with these banks and credit unions, and look at kind of alternative or non-GFC product is maybe a better way to say it that's out there. So all that, I think we're right about on time here, and we're going to move into the Q&A. So I'm going to start.
All right, so thank you so much for sharing that. Before we get into Q&A and any questions that you have, I want to share with you the current primary mortgage market survey from Mr. Freddie himself. I think it's a Mr. I'm just saying. So as you can see on this slide, see if I can see you guys. As you can see on this slide, as of 10/13, your 30-year fixed rates are 6.92 at a cost about 0.8. Okay, so almost 1 point cost. And then your 5/1 ARMs are going to be sitting at the 5.81. So a little over 1% lower in the current market, not a huge spread, 1.11 on the spread. And of course, this is at a lower cost. Since we're in Silicon Valley, we tend to have larger loan amounts, and that cost really factors in for our buyers. So it's something to be very leery of in reference to doing ARMs. Adjustable rate mortgages, they can be wonderful for your consumer, but you may want to think, sorry, all the mortgage brokers in the room, you may want to think of using somebody who has a portfolio product that isn't going to be subject to this slight difference in the market, and they can portfolio those adjustable rate mortgages and have a little bit bigger spread, so the benefit is even higher. So that's just something to think about. Hope that information, please log down the website here. It's Primary Mortgage Market Survey Freddie Mac. You can link in there. It is a trailing indicator, meaning it is 1 week behind.
Thank you, TJ.
All right, go ahead, Harper.
Yeah, no, I really appreciate that. And I think that's a really good point. One of the things that I work with a lot of different lenders, banks, credit unions. And to your point, TJ, I think that, you know, right now there's some opportunity to work with portfolio lenders. And again, you know, brokers have access to lots of those products, which is really nice. So you all have that. I think the important point is to be very aware of what tools you have available at your fingertips, how to overcome the objections that your borrowers may have, some of the opportunities that they have in using these tools. Everybody is kind of coming off of that 2.5% hangover. You know, it's it's tough, but this is the market. And if you remind your borrowers that first of all, everybody needs a home. Every homeowner was a first-time home buyer at one point, and the key point is to get into that home today versus tomorrow, show them the long-term benefits. I think that this is one step further to just helping our market along. So great opportunity to share that message. Let me stop there and see if there are any questions. I don't see anything in the chat box.
Okay, I didn't see any questions in the chat box either. I want to talk about why does this make a difference for you real estate agents who came to join us. As I showed on the spread, we're looking at about a point difference. And if we're talking about a $900,000 loan, you know, we're talking about $9,000 that the buyer is going to have to come out of pocket. What we're seeing in this current climate is our values are still holding. They're not going crazy with a 100,000, 150,000 or more overpriced, but they are coming in within, you know, 101 to 99, 98% of list price when they're listed accurately. And what the sellers are doing to offset this mortgage cost is they're giving contributions to closing costs. And there are certain amounts they're able to give. And as I expressed in some of the real estate meetings, we just had a 6% or $56,000 credit from the seller to pay down the interest rate, which is another option for you. So getting a fixed rate by buying it down further may get you more bang for your buck in getting qualified, getting them with a more comfortable payment. But also you can buy down the adjustable rate mortgage. They're usually capped at as much as maybe 2.5 point buy down, whereas you can do a lot higher buy down on the 30-year fixed rate. So that's something to keep into consideration when you're looking at both of them. One of the other things that we're seeing, contributions to closing costs, and I always sold against ARMs. I even actually sold against the option ARM back in the day. And when I sold against the option ARM, what did I sell? I sold the 2-1 buy down. And I want to kind of show that to you and how it works. And please feel free to ask questions. Go ahead and put them in the chat box. Raise your hand. This is your forum. I'm going to go ahead and share a
TJ,
screen.
while you're pulling up your screen, I also want to point out, since contributions are coming up, MI can be paid for as a seller contribution. So you can structure your loan if you're trying to keep the payment down as low as it is, as low as you can, or help your borrowers qualify from a DTI standpoint. You need to take some cost out of it. Consider doing a single premium and having the sellers pay for that as a contribution. It's a long-standing tool, but not a very often used tool. So I think that's something
and it makes a dramatic difference to have the seller pay it versus the lender paid mortgage insurance. Lender paid mortgage insurance is paid over the life of the loan, is much more expensive to the consumer and has not as much benefit in the rate reduction. Whereas getting the single premium paid as a contribution to closing costs by your sellers is an excellent way to help lower that payment for your consumer. So thank you, Harper. That is very, very true. And I have done it with my with my sellers. So I want to kind of show you this 2-1 buy down. Does everybody understand the 2-1 buy down, exactly what it is? It is we're not talking the compressed, because there used to be a compressed and it may come back. It's called the 3-2-1 compressed buy down. But the 2-1 annual buy down means you buy, your interest rate is 2% lower than your note rate the first year and 1% lower the second year. And then years 3 through 30, it is at the note rate. Why is that significant? I'm going to show you a little worksheet, and any of you would like to have this little worksheet to do the computations, they can. But we'll just pick up a rate here. See if it'll let me get into the spreadsheet. Okay, so we're going to say, well, we're going to do a $900,000 loan amount. Why not? Sounds more like our market, right? And let's just say our interest rate 7.25. Automatically does all the math for you, which is super nice. So your year one will be at 5.25. Year 2 will be at 6.25. Your full note rate payment is $54,3750. But in the first year, your borrower is only paying $3,937.50. Okay, that's a significant savings on their monthly payment. Another way to help them feel comfortable with the rising interest rate market. The second year, they'll be at $4,687.50. They always know what their payment is going to be. At the full note rate, that would be your total amount. And then it shows you for the 12 months, it's this amount. For the other 12 months, it's this amount. So that's the difference between those two, or a credit of $27,000 in prepaid interest. Now I'm going to tell you a secret. Don't let anybody know. I know this is recorded. But on a 2-1 buy down, your borrower actually gets 2 benefits on their 1099 INT statement. They are actually paying the interest rate at 7.25, and that's what they get as their deduction. Even though it was subsidized, the note rate is still paying at 7.25 because that was prepaid interest. Now, the other thing they get to deduct when they buy a home is points. Points is the cost of originating it, and those points will show up on their closing statement. So I have had people who get double deductions for the same prepaid interest because of the way the law is written. So just to let you know, that's how it works. Now on the 1-0 buy down, it's going to be the same thing. You're going to go from 7.25 to 6.25. And then you're going to have a fully note payment of $54.37. And again, look at that deduction. You know, you're looking at $800 a month in lower payment. You know, they're afraid to buy because the rates are so high. Well, there's no prepayment penalty on this. When rates drop, they can refinance. They're not an adjustable. They always know what their payment is. It gives them the ability and the flexibility to be able to feel more comfortable with that payment in this interesting economy that we're dealing with right now. So then the total amount they would have paid, the total amount that was subsidized, and so it'll tell you the difference is $9,000. Now, can you have a low interest rate that points, you know, say it's at 1 point cost, and say you get down to 6.625, and you pay the 1 point cost, and you do the buy down? Yes, you can. That's an opportunity to pay the $9,000 plus the 1 point, so it'd be an $18,000 credit, and now you've made their payment $4,200. Now, for qualifying on a 2-1 buy down, it's not like the olden days. We used to let you qualify at the note rate. I mean, at the start rate, but not anymore. You actually qualify at the note rate on all buy downs. So they're looking for that risk that you understand what your payment's going to be once the subsidized interest is gone. So if there's any questions on the buy downs, we still see 6 point. We don't see that on the screen. You don't see this part of the screen, the 1.0 buy down portion right here? Can you see that, Harper?
Yep, I can see it.
Okay, maybe it's the way your screen's set up, Joseph. It has the 2-1 on the left and the 1.0 on the right. Let's just change the interest rate to 5. Not that any of us have 5. You can see how the numbers all change through. So this is a nice little worksheet. You only fill out the orange part and then it'll calculate the cost. Now, what I have been telling my real estate agents that I work with when they have a listing, how do you get more buyers available? And you don't automatically just lower the price. In this rising interest rate and cost market, the best thing you can do, because your value is supported, is keep your price at the accurate price of the last closed listing of that property. And have an incentive that you're going to be paying buyers' closing costs up to 3%, 6%, whatever is allowed. Your seller will still net a better amount than if they drop the price that 6% or that 10% that they have been doing. Their net will be better, the market will stay more flat, and it will help those buyers get in on a property and have a lower payment. So those are the things that we do as a tool to help you guys sell and get them into contract. Any questions on that? Joseph, I will email you the spreadsheet, okay, hon? All right. So I don't see any questions. Let's see who else we have on here. Any questions regarding that? But
I have a question.
go ahead, Pat.
Yeah, thank you for, when the market started to change, I was thinking about this because I did a lot of that in the 90s. And now you're speaking about it. So that was a good point, what you just said. Have the people price a home appropriately and build into their marketing that they will pay a buy down.
They'll pay a buy down, or they'll pay for points or credits for their impounds or closing costs. Yeah, 3 and 6 is allowed, except for a non-owner. Non-owner allows 2%, but 3 and 6 is allowed. Now, you also have the component when we were talking about adjustable rate mortgages. You're going to see in the market non-QM lending that allows interest only. What is an interest only loan? It's one that doesn't pay any of the principal. So what happens on an interest only, it's a very simple interest calculation. You don't have that principal reduction on your note. However, your payment only pays the interest. You don't get negative, you don't have any negative growth, but an interest only payment is a great option. There are mortgages out there as well that are 40-year fixed mortgages that have a 10-year interest only component. They're fixed for 40 years. Your rate never changes. Your payment will change after 10 years, but for those 10 years, your cash flow is exceptional. Right now, we are in a buyer opportunity market, but the best opportunities are for investors. The products that are out there for investors the DCR loans, the property just has to debt service, things along that lines, you're going to be able to get them great debt servicing on an interest-only payment. So this flexibility that we have to have in the mortgage market to be able to help sell those homes that you guys are getting on the market is what we all work together to have. So I appreciate you guys joining us today. If there are no further questions, I would love Harper to give us a little commercial on what mortgage insurance can do for you.
Sure, thank you, TJ. I really appreciate it. And thanks everybody. Like I said, the recording of the presentation today by Kevin is available as well as screens. So if you have lunch and learn or an office meeting, or you'd like to share this with anybody or refer back to it yourself, feel free. I'll be happy to send that out to you. I know TJ is going to post the recording. MGIC has been serving borrowers above 80 LTV so we were talking about some of the non-QM products and some of the products that are out there. MI is a very important component to your suite of products. And as we talked about, we're looking at ways to cut costs. If you go from 80 to 85% LTV on your loans, a lot of times you'll see that the cost actually drops because the LLPs adjust with that counterparty risk that MGIC provides for you. So think about that as another tool. It's a lot to think about, but we all have to work in our business, not just do our business. And I think it's a great opportunity to hone your skills. I'm available to answer any questions that you have about MI and how to structure it, how your sellers can pay for it, how your buyers can benefit or just tweak a loan a little bit. So feel free to reach out to me. But in addition to that, like I said, I have many resources available to you. If you're reaching out to different demographics like Hispanic homeowners or single women, or maybe you're trying to crack into different referral partners such as human resources or financial planners. I know you don't probably think about an MI partner as that, but we're trying to earn your business and we have great resources. So don't hesitate to reach out to me.
Can you
MGIC.com is your friend. Most things don't require a user ID or password either.
Yeah, if you could put your contact information, Harper, I really appreciate it. If you could put it in the chat box as well as your website. Fabulous tools. They've been a great partner of mine for over 20 years. And I love working with them. They had one of the best classes I'd ever seen on the first time homebuyer experience and how to walk them from point A to point B, budgeting, everything that they need to know, because most people don't know that kind of stuff when they come into buying a home. So it's super important that we educate, and provide those resources. Two other ways to use mortgage insurance. What she was saying that may not have been clear is your interest rate is lower if you're at an 81 loan to value, 85 loan to value, than you are at an 80 loan to value. So that little bit lower interest rate and little bit lower cost actually makes your payment smaller, because even though you put less down, because the mortgage insurance premium in there takes part of the risk, and that's why the pricing is better. So what I do as a lender, and I'm sure some of the other lenders here do, is when I approve a buyer, I approve them at 80% like they'd like, and I look at them at 90%, and I look at them at 95 if the product has it, just in case our value comes in short. They may not have the cash to write the check, but as long as they can qualify for the payment with the mortgage insurance and not have to worry about the fact that the value came in a little low, it's a good way to have that backup piece for making sure the buyers are qualified. So giving them the confidence that they know, even if the value comes in a little low, that they have the ability to make the payments is super important for the consumer and for closing more transactions for you real estate agents.
Yeah,
So,
and MI is about as inexpensive as I've ever seen it in my long tenure.
oh, it is
MGIC.
amazing.
Yes,
I have had mortgage insurance premium at just over an eighth of a point in a month. So less than a quarter point in mortgage insurance premium on some of those 85% loans. It is significant. Yes, Pat, you have a question?
Yeah, is the reason it's lower nowadays is because it's tougher to get a loan in the first place? They know that the buyer is a hell of a lot better than they were 15 years ago?
I wouldn't say that. I actually would say that the reason why MI is inexpensive now as it is because we went to a risk-based pricing model about 6 years ago. And because of that, we've been able to get very, very granular with our pricing. If you remember back in the day, we had a rate sheet. It didn't change very often because every time we change rates, we have to file as an insurance company. We have to file with every state. It was very difficult to change rates. So we had buckets of rates. And because of that, it was a little bit more expensive. I think our margin was a little bit higher. And now we're able to just price it much more granularly. So the higher quality borrower you have, the better, the lower the DTI, the higher the FICO score, the fewer risk layers that you have, the better the pricing is going to be. And it is, I've seen it. I've seen some rates that I'm like, wow, that's amazing. Another point that I know will come up with your borrowers when it comes to mortgage insurance is MI cancellation. And TJ mentioned the benefit of going from an 80 to an 85 or 81 LTV and just having that little bit of MI. The MI will cancel automatically very, very quickly when you have a low LTV loan, like an 81 or an 85% LTV loan. The MI will drop off without the borrowers having to do anything. But MI is a great opportunity for you to do a mortgage check-in with your borrowers once a year when they get their mortgage statement, their 1099. Talk to them about MI cancellation. So just put it on your calendar every year and reach out to your borrowers.
And just to correct, it's actually a 1098 INT form.
Oh,
but you know what I'm
yeah,
talking about.
Yeah,
You're copying me.
Yes.
Yeah,
Thank you.
but no, it's just, we're talking about the same form. It's your tax deduction form 1098 INT. I used to do the other side, the 1099 paying the investors. And that's what they get when they get their investor yield on trustees. So along that lines, I think, go ahead, Pat, you have one more, hon?
Yeah, I'm sorry, I missed it.
No.
What's the mechanism nowadays to get rid of MI down the road?
Okay, so normally what you do, it automatically cancels at 78% of loan to value based on your appraisal on your loan. So when you purchase property for $1 million and you get down to that 78%, it automatically goes away. You do nothing. All of a sudden they get a coupon saying, oh, your mortgage insurance is gone. Your payment's gone down $108. They do nothing. It's automatic and it's required by law. This is not the same for FHA. That is monthly mortgage insurance. And normally there's a few exceptions. It's there forever and it's very expensive.
Okay.
Very expensive.
Wasn't there a time where you could petition to have it removed by having appraisals and whatnot? Or is that not the case?
Yes, you still can. Normally you need to have a minimum of 2 years payments paid on time. You have to apply to your loan servicer to have that removed. And if you're working with a very good mortgage lender, they'll kind of help you through the process to be able to get that done. They do not have to, by law, remove it until it amortizes to 78. However, normally if you have 24 months, sometimes they want to see 36, depending on the servicer, of paid on time payments, and you provide an appraisal, and sometimes they don't require an appraisal in the market that we were in with the values going up as crazily as they did. They just accepted the value. They did an AVM and said, let's just go with it. We want to keep this interest rate before you drop to a 2, so they kept those loans and they got rid of the mortgage insurance and assessed the risk. But yes, you can apply. You do need to have 2 years of payments for any servicer to consider it because it's extra insurance for them.
Okay, great job, everybody.
All right. Thank you for joining us at Silicon Valley Camp. We really appreciate your support. Just to let you know, we do have our Christmas party coming up on the 8th of December over at Maggiano's in San Jose. Would love to see you. We have a great speaker. Rob Crispin is going to be coming out, and he is everything you need to know about the market and the secondary and how it all impacts it. And yeah, I'm blonde. These things don't always register with me. So I have to see it a few times for it to make sense, but it's some very good stuff. He speaks in plain English and he really knows the history and where we're going forward. So look forward to that. I'll send out links for coming to join us. Harper, thank you again for joining us. Great topic, great information. Love the video. I loved how it was condensed. It can be rolled out to any realtor, it can be rolled out to consumers. It's just a great way to explain how it all works. So thank you again, and I will see you next month.
Thanks, TJ.
Bye, everybody.
Bye, everybody.